Yo, CPA Strength here, back again with another video. Journal entries made easy, strongest in the game. I might be the fattest in the game right now. I haven't worked out in a couple days, but that's besides the point. But we're doing these daily videos, doing these daily accounting videos. We're on Accounting for Beginners, 128 of my classic series. We have the best accounting playlist in the world over here. It's got all my Accounting for Beginners videos up in here, a bunch of stuff. So we're going through, as you can see at the bottom of the page here, we got our next journal entry to do here. April 1st, Adams Family Inc. opened, and we're doing a bunch of journal entries. Now we got April 7th journal entry. We got my DCA, we got DC Adler here. This is like a mapping system of everything. It's like the whole world mapping system, the big overview. If you have an asset draw or expense increasing, you're going to debit it. If you have an asset draw or expense decreasing, you're going to credit it. If you have a liability, equity, or revenue increasing, you're going to credit it. If you have a liability, equity, or revenue decreasing, you're going to debit it. And then we have down here, cash is an asset. You got to remember cash is an asset. Now this journal entry does not have cash involved in it, but most of these do. So what do we got here? April 7th. So here's our April 7th here. Purchased additional office furniture on account from Morrilton Company, $1,800. Purchased additional office furniture. We got a capital contribution on April 4th of some office furniture, but now we're purchasing more. So in the general ledger account of office furniture, we're going to add this to it. So we're going to have $7,500. That was the April 4th. Now we're going to have $1,800 on it. Well, let's do the journal entry, shall we? Purchased additional office furniture on account. So we can go two ways. We got two things. Let's say what we got. We purchased an office furniture. What is office furniture? If you don't know, if you haven't done this before, office furniture or furniture is going to be an asset. So it's going to provide an economic benefit. We're going to have this furniture for 4 or 5 years. It's going to depreciate. So it's going to be an economic benefit for our company. It's going to be a fixed asset on the balance sheet because it's fixed and we're going to depreciate it. But that's for another time. If you're just trying to do this journal entry, you got to know office equipment. Office equipment is an asset. If you don't know office equipment's an asset, you probably want to, you want to write down next, whenever you're doing journal entries and you come across something, you probably have cash written next to asset. And look, let's do, what else is an asset? We can do office equipment right here. Office equipment. Or that's an asset as well. So now you purchased office equipment, you're getting office equipment, you figured out, I think the first thing is you got to figure out what office equipment is. Office equipment's an asset. Is it increasing in value or decreasing in value? You have an asset, office equipment. It's increasing in value because you're purchasing it. So you're getting more. You're getting $1,800 more of office equipment. So the office equipment account is increasing. If an asset's increasing, you're going to debit it. So we're going to have debit. We're going to office equipment. That's going to be our debit, office equipment. And it was for $1,800. Now usually, the way I think I would think about this is, usually you purchase something, let's say you purchase it with cash, you would have less cash, you would have cash leaving your account, and that would be the credit. But we did not. We bought it on account. And now after doing these journal entries for years and years and years on GP, on some games played, you're going to realize on account means, well, it's on an account. Means you did not pay. Let's say you did not pay for the office equipment yet. Account, it would be an account payable. That's usually what on account means. But you got to think, did you pay for it yet? No, you didn't pay for it yet. So you're going to be liable for you're liable for it later. Well, it says on account right there. So accounts payable. It's an account payable. You're going to be liable and you're going to be payable. You're going to pay it later at a later time. Does that make sense? Now you haven't borrowed from, who is this? Or Morrilton Company for $1,800. You're borrowing, or you've got office furniture on account, and you say, hey, I'll pay you later for this. I'm not gonna pay you now, I'm gonna pay you later for this office equipment. So I'm gonna pay you later. So I didn't have an account with you before. Now I owe you $1,800. So I owe you, I'm liable for it. So if a liability is increasing in value, it's going to be a credit on account. It's an account payable. So that's going to be our credit. Account payable. Accounts payable. $1,800. That's how much you owe them. We have $1,800 equals $1,800. That's good because debit's got to equal credits. We're getting office equipment. That's an asset. We'll write that down here. That's an asset that's increasing in value. So that's good. That checks out. We also have an account payable, which is a liability, and that's increasing in value as well. So that checks out. So the story checks out. Hope you learned something. Hope you had an enjoyable time. We'll be back tomorrow with another journal entry made easy. Anyways, for now, this is CPA Strength, and I'm out. Deuces.